let's start with Jake and then Aleksandr. Jake, you're seeing a lot of activity in the token offerings space. And one of your services is, the way I understand it, is crypto economics. So what is crypto economics and why is it important?
So if you go by Vitalik's definition, I think he has like a really interesting way of kind of describing it, which is to say
closer. Can you hold the mic?
Which is to say that crypto economics on a protocol level is a combination of guarantees about the past provided by cryptographic proofs, together with some probabilistic guarantees about the future provided by kind of economic incentives. So the way that we work with crypto economics is kind of in a higher level context than that. It's in the context of understanding how a particular token works, what are its properties, and those properties have kind of profound implications about how it will be priced and how it will trade. So we at CoinFund, when we act in an advisory capacity to teams, we help them work through those kinds of problems of structuring, building their tokens, and understanding how those tokens would behave.
Can you be specific and talk about the different variables and the parameters? Like maybe walk through an example, a theoretical example.
Actually, do you want to?
Could you? If we can close the doors as well so we don't hear the noise at the back, thanks.
Yeah, one of my favorite projects to illustrate crypto economics on, and the one that actually helped me learn this whole subject is Coin. Because Coin has exceptionally clearly defined economics, and it has such parameters as, what is the token used for, very clearly defined. What is the supply dynamic and how much of it is going to be added into circulation and in what circumstances and over what period of time. The transaction fees and the CoinFund's token are also very clearly defined as the way to monetize it. So that's an example of a very clearly defined economics.
How are they clearly defined? Like, can you talk about the specifics of that?
Well, there is a fixed inflation parameter. There is a fixed transaction fee. There are clear alignments between all the parties, including the developers. And to make a general note, I think just to add to what Jake is saying, we look at crypto economics as a way to align behavior in the entire ecosystem of the application. And it's very important that when we look at economic structure, that we see and can prove to ourselves that that's in fact what's happening. Because very often these models neglect certain scenarios and certain parts of the ecosystem and leave out very obvious ways to game it or to extract value without bringing benefit into the system. And those are the kinds of things that we're trying to catch. And I think economic review of these projects is going to eventually become something as important as, for example, a security review.
Okay. So what could go wrong in some of the ones that you have seen? Are there, do we have enough history that best practices are emerging? I mean, is this going to be a cookie cutter kind of thing, or are we still, everyone is a bit different than the other and we're still learning to find what's the common ground?
I think this space is currently developing an understanding, and it's happening slowly, but it's happening. And the kinds of things that can go wrong are, for example, people sometimes say, when our product gains user base, the value of our token is going to increase, and that's actually not always obvious. And at the moment, the reason why it's so hidden is because of the speculative dynamics in the market, which pretty much at the moment are hiding the actual underliers of a lot of these tokens. So, I can say, well, it's not clear that the price is going to rise, and then the price rises during, due to speculation, and people are like, well, the price went up, and I'm like, well, because of speculation, and so, we are not yet at the point where these mistakes are actually biting people.
But does speculation, in a way, give more strength to the business model, or does it give more wind into the sails, and it helps it in a way?
Yes, exactly. So the way I look at a project is as having two stages. For example, if you take a social media vertical in blockchain, it's exceptionally hard to enter the social media space because of the network effects that are not there at the outset of the project. So speculation and crypto economics are generally an amazing way, illustrated by the Steemit project, which is pretty canonical at this point, to incentivize users to come into the space, even though the space is not very big. So you build a social media app and you're basically paying users using speculative token to come into your application. But there has to be a clear delineation between that as the first step, and then the second step where the application is actually in a stable state and already has the network effect, and it has to support the speculative promise that it gave during the first stage.
Yes. Alex, what are you seeing in your research? 'Cause you're now the head of research at CoinDesk. What's the latest and stock data and numbers?
CoinDesk authors a quarterly kind of industry overview report called The State of Blockchain. It's designed to be pretty broad, so we go into all areas, Bitcoin, Ethereum, some other public blockchains. So this quarter, I did a piece on prediction markets, sort of privacy-focused assets. We also dive into enterprise blockchains and sort of just the overall regulatory and legal climate. This quarter, we did a sentiment survey on sort of the sentiment around Bitcoin and Ethereum. I thought one of the most interesting takeaways were just how torn people are currently on the state of Bitcoin, seemingly for things like rising transaction fees. So in the Q1, the average transaction fee on the network was over 60 cents. There's long periods over $1. So people were pretty torn about that. There's obviously a bunch of centralization going on in China. These fears of a hard fork and just what's going on there. But on the Ethereum side, less than 5% of all people I surveyed had anything negative at all to say about the state of Ethereum. What's interesting is I also asked people what they thought the sort of Q1 price driver was for Ethereum. Seemingly perhaps developments on the protocol or dApps, for example. And overwhelmingly, people thought it was actually the launch of the Enterprise Ethereum Alliance. So just being in the community and being at places like Consensus the last few days too, you can sort of just see that sort of the crowd of the crypto space is obviously growing and shifting. More traditional people are becoming involved. More and more suits are around. Organizations like Hyperledger and the Enterprise Ethereum Alliance are bringing huge credibility to this space with all these traditional finance and tech firms. And really think everything's just kind of shifting and maturing. People also are really keen on this trend of interoperability, which is the Enterprise Ethereum Alliance really laid out in their mission. And when I ask people really why they're buying these tokens, speculation and investment still is the leading cause. But those are just some of the summaries from, I guess, this report. But this whole 100-page plus report's going to go live this week, so there's a bunch of data in there as well.
Is it because the usage is not very obvious, so people just go for speculatory activity as opposed to, because the tokens have to have a utility. They are not just there to be traded on the markets, although right now they are, of course, it's part of it, but there has to be a relationship between the trading activity and the usage activity by users.
Absolutely. I mean, Bitcoin is used a lot lately, so I thought it was really positive, actually, the fact that the average transaction fees were so high in Q1, yet we also saw a record number of transactions. So over about 300,000 transactions occurred every day on the Bitcoin network. And Bitcoin's commonly used for things like cross-border remittance and stuff like that. Some of these other networks are just a bit earlier, though, so really this whole flood of investment and speculation really does just get the wheel going, sort of decentralize the holder base, really start getting media attention and more coverage to these projects, which brings developers in. It's definitely a full circle, but of course there's more usage on earlier platforms like Bitcoin than some of these Ethereum dApps that are yet to really be launched live yet. So
aside from Bitcoin and Ethereum, which is the obvious kind of ones in the lead, which ones would you say would be number 3 and 4 and 5 in terms of activity?
Well, there has been increased transactions on kind of all of these privacy-based coins. That's why I kind of launched a subsection on that. So Zcash, Monero, and Dash sort of all saw record transaction numbers in Q1. I think we're starting to kind of see certain sectors as well. So prediction markets are an obvious big one, yet these platforms are pretty early, yet there's a bunch of interest around like Augur and Gnosis obviously as well. Yeah, so really kind of these privacy-based transactional currencies is what I see as the obvious, like data obvious, more people are using this.
Okay. So Sid, tell us a bit more to start about Smith+Crown. So you didn't exist a year ago, right? More or less?
We have kind of existed in some form, but yeah, in specifically what we do now in terms of providing this research, yeah, we have. So our idea is to be like the most legitimate research. So we are a blockchain research firm, and we usually derive insights which are data-backed. So we try to understand the space, but not purely from a market perspective, but also from like a broader where the space is evolving and what the tokens are and what they represent. So for instance, one big takeaway that we had while preparing for this conference and gathering all this data was just taking a step back even from what traditionally has been like the crypto economic models and just understanding what does the token even represent. Because we call them all these different names. You can call them altcoins, dApps, protocol tokens, like anything, but they're not all the same. They have very different characteristics. So we try to classify those. So for instance, your token could purely be an economic value. So it could, all it does is like provide you that economic benefit based on the success of the project. Or it could be the only way that you pay for the services which the project is working on. Or it can be a governance model. So you as a token holder could have a say in how the company evolves. Or it could be a consensus model in the sense that as a token holder, you are responsible for setting the parameters of the consensus of the blockchain. And we have examples for all of these tokens. So I think just this space, I mean, we all know it's a very fast evolving space, but even within like the last year and a half, where we have seen this explosion of new tokens, I think it's very important to understand what the token represents, because many tokens do represent multiple of these parameters.
Yes. Jake, can you talk more about the kinds of projects that you are getting involved in? And is this giving you any idea as to where things are going? Because projects come to you 3 to 6 months before they want to launch, so you have a little bit of a visibility ahead. So can you comment a little bit about what you're seeing that might happen over the next 6 months or so?
Sure. So for the most part, we have worked with early stage blockchain projects. But as we see today, I think the interest in this space is growing and kind of extending out into the greater technology market as well. And what we see is a lot of sort of maybe like mid-stage or even like later stage traditional consumer tech companies kind of paying attention to this space, both from a technology standpoint and from a fundraising standpoint. So one of the most common sort of models that we see being explored by technology companies is getting away from ad-based monetization and understanding whether a cryptocurrency-based model can serve to compensate curators, content creators, and sort of get us away from advertising a little bit and create a sort of a fair world.
So you're seeing a lot of activity in this area of content, like attention. Is this part of the attention economy, kind of monetizing attention?
Exactly.
Or publishing?
And about a year ago, there was just maybe one project working on that, which is Steemit. And today we see Steemit, we see Basic Attention Token, Akasha. We see many sort of traditional companies who have things like video streaming or messaging, like all of the applications that are traditionally able to be monetized one way and one way only are kind of thinking about new models. And probably the biggest one you've heard of, and this is not related to crypto, but is Medium, right? So Medium just launched their kind of membership model, and like literally very explicitly stated that we want to get away from advertising, and we want to focus more on compensation for creators.
Good time to segue now into the presentation. The blockchain has just confirmed the arrival of the presentation for Brian. So it was a delay in the confirmation. That's all that was, really.
Yeah. Well, let's hope. Fingers crossed there. All right, great. All right, great. Thanks for the patience there, guys. A quick background here. My name is Brian Leo. I'm the CEO and founder of Smith+Crown. Sid gave a brief background, but in essence, we're a research group that covers the breadth of the blockchain space. We believe quite passionately in the transformative, disruptive, and quite positive power of the blockchain. And we think one of the things that is absolutely critical for the successful development of the industry and the organizations and individuals within it is reliable, thoughtful, insightful, and impactful information and research. So it's our goal to provide that in whatever formats make the most sense. So what I'll be doing is very quickly, over the next 8 minutes or so, taking you through a series of 9 different observations. Then the panel can jump in and talk a little bit more about what each one of those means. This is going to be a bit of a whirlwind. So immediately after this, all of the information as well as context will be available on smithandcrown.com for you to review in more detail.
And can you let us know, you are announcing some new numbers and new research today, is that correct?
Yes, yeah. So we haven't published this before. These are all new insights. Some of them will seem familiar. Some of them will confirm theories you've already had, and hopefully there's some interesting insights in there as well. All right. So let's jump in and look at the token sale market as a whole. So on the top, we have total amount raised, and in the same periods of time below, we have the number of token sales in each time period. So, as many of you may suspect, this number has been going up. Two interesting observations here. One, in 2017, we have already meaningfully eclipsed all of the money raised in 2016, and it's being done with fewer projects. Simply what this means is higher caps that are being achieved. Right now, over the last few months, or if you look at last year, $10 million would have been an outlier. Over the last few months, it's closer to average. Next, we're going to look at investment types. So this is CoinDesk venture funding information overlaid with token sale information. As you can see, in the early days, there was a clear preference for early stage venture capital. This covers seed and Series A. But over time, as token sales became more of an understood option, more of a viable option, you can see there's a clear preference and movement there. And it will be very interesting to see what this does over the next couple of quarters as well. Next, moving right along, we'll look at a distribution of token sale amounts. So 2 quick notes on what's contained in this. So first off, this is a pretty broad set of token sales that are included in this, but some things that are not. Any token sale that was unsuccessful or refunded the funds it collected, this includes the DAO, or any token sale that raised $25,000 or less, which is about the average raise for a Kickstarter project. So this is a distribution of all the raises. A couple interesting notes here. One is a lot of our attention, a lot of the media, a lot of discussion tends to focus on high-profile projects with large target raises that get a lot of kind of hype around them. But the reality is there's actually quite a long tail of projects with much smaller asks that are successful in raising those amounts. They fly under the radar, but there are quite a number of them, actually. On the whole, the per sale raise average is about $2 million, which is not too far off from the average seed stage venture investment. Next, we'll look at a graph that some of you may be quite familiar with, perhaps excited about. So these are returns on Ethereum, indexed to 1, so you see 80x, 160x, and so forth. Another note on these slides, all of this data was finalized last week, so we're all familiar with how fast the space moves. So there's obviously additions to all these slides, but overall the trend still holds. So I won't dwell on this too long, but it's an important benchmark moving forward in terms of the kinds of returns that the Ethereum sale provided. So next, we're talking a lot about the number of sales and the amount they're raising. One important question, on which platforms are these sales and new token launches taking place? So interesting thing to think about is what did the launch of Ethereum do for the issuance of tokens on the platform, and what does distribution look like there? So Ethereum definitely lowered the barrier to entry and provided a pretty powerful platform in terms of launching tokens and raising money via smart contracts. But the interesting reality of it is that there continues to not be a shortage of tokens that are launched on other blockchains and additionally new blockchains. So it's very much still the battle for dominant platforms continues in quite a strong way. So Next, we're going to dive into a few different looks at overall performance of the space. So for this, we did a little thought experiment. If you put 1 USD into token sales, how many of them today would be worth more than that original USD that you put into it? So about 45% of projects as of today haven't launched a token, will never launch a token, or are worth less than that original investment. However, there's an important caveat here. That dollar that you put in likely wasn't USD. That was probably money that was already in the crypto ecosystem in some format, so that was likely Bitcoin or Ethereum. So if we look at that same thing and said, at that time, if you had put $1 into Bitcoin or Ethereum instead of that token, which investments today would have actually beaten Bitcoin or would have beaten Ethereum? So for Bitcoin, it's about 40%, just over 40% would have beaten it, and for Ethereum, it's closer to 20%. So next, we'll take a different look at returns. So this is lifetime returns of different projects, all of the ones that were positive, so that actually had positive returns. So in aggregate, there's quite a few here. You'll see Ethereum's quite near the top. There are a few outliers with some unusual sales structures that did better than that. But an important note on this one that's interesting to point out is though Ethereum has done very well and remains near the top of the list, it has also had quite some time to accumulate this value. Many of the sales listed here have not had the same amount of time, so this will be very interesting to watch as we move forward to see how value accumulates across the breadth of these projects. Okay, so now let's look at it a different way. So we know most of these investments to date would not have beaten Ethereum. However, what about in aggregate? So we did a little experiment and we said, if you had put $1 into every token sale that has happened so far, or you had put $1 at that same point in time into Ethereum or into Bitcoin, what would those benchmarks have looked at? And then additionally, if you had just started after Ethereum had launched and put $1 into every token sale, what would those returns look like? So in both the cases where you invested into every token sale or you invested into post-Ethereum token sales, you would have done better than a benchmark investment, putting $1 in at each period of time into Ethereum or Bitcoin. However, again, the important thing to note about this is that a large part of these returns do come from a few outlier projects that make up most of them. And it will also be interesting to see how these projects develop over time as they have more space to mature in the marketplace. So throughout all of these other slides, we have talked about finance in some form or another, but the reality of it is all these token sales are raising money to do something, to launch a token and then to move that forward in some kind of productive way that provides utility. So it's very important to look at how projects are moving forward, how many have continued to develop, and how many have made it to secondary markets. So we took a few different looks at this. So there's two views up here. So one is all projects with token sales as of last week or so, and another one excludes the last 6 months, assuming those projects need more time to get out into the marketplace. So some interesting things here. We have two metrics that we looked at. So one is tokens with trade history. Did a token make it to a secondary market and achieve at least $15,000 in daily trading volume? So we consider that minimum liquidity. And was there a major project update in the last 3 months? So as you can see here, not all projects by far made it. However, if you compare that to companies that have received a seed stage investment, those typically succeed at about a 30% rate. Right now, it's far too early to say how token sales stack up overall. But if you look at the advantages that they provide to investors in terms of immediate liquidity, and their success rate overall, which is hovering around 40%, even for all projects, so far they're more than holding their own against traditional venture investments as a vehicle. So I know that was kind of a whirlwind dash through a whole lot of information. I will repeat this. This will all be online on the site for you to take a deeper look at. And myself, as well as a few other members of the Smith+Crown team, will be around all day to answer questions and discuss in more detail. With that, I will kick it back over to the panel so they can jump in with a discussion.
Before you go, Brian, I have a question. One of the slides you had meta token as a category. What is a meta token?
So a token on top of another platform.
Of an existing
Right, so
blockchain.
not a unique blockchain.
Okay. I want to just see if there's a question from the audience before we go back to the panel, because there's lots of data there, I'm sure. Let's take that one there, and I'm going to repeat the question.
You showed $1 going into all token sales. Presumably there's 100, 200 tokens. Is there $100 going into Ethereum and Bitcoin, or only a single dollar?
Right.
Can you repeat the question?
Right. Okay, so that was just a question about the methodology of how many dollars were put in and how we measured that. So it's roughly 130 that were in the set for this. We can get more specific about that. And what we tried to do is we tried to put it at the exact same time. So at that period in time, if you had invested that dollar into the token sale, had at that same point in time, you invested $1 in Ethereum. So it is additive. As you invest in each token sale, you would have put that dollar into Ethereum at that point in time as well.
Okay. Any reaction from, thanks very much, Brian.
Thank you.
This was great data. Any quick reactions from?
So, William, maybe I could augment a little bit some of these stats, and you guys in the audience might be wondering, like, who's causing all of these statistics besides yourselves? So we at CoinFund, we did a survey which included some demographic information about who's buying into these sales, and it's really interesting. It's on a few axes. So 91.5% of the respondents were male. 66% of the respondents were between the ages of 25 and 40. About 60% of respondents worked in a technology field, and about 26% have previously participated in a private equity funding round, suggesting that they might be accredited if they live in the United States. So they're fairly on a higher level of sophistication. And the craziest stat was that out of all of their investment capital, the average percentage invested in blockchain assets was 50%. And 1 out of 3 people had over 75% of their investment capital in blockchain. So it's still a very niche market. It could probably have a few more women in it. But you can also see from the statistics that it's spreading.
I guess to add some context to that, a similar survey question I asked was like, what is the most amount of your portfolio you would consider investing into a single ICO? I believe the average answer was about 20%. Also, one question was, for those who have not yet participated in an ICO, what's been the biggest reason keeping you out? And it's been a lack of third-party information and research. But I really think the fear of missing out is so high here, and a lot of these people investing in these tokens are just reinvesting previous Bitcoin and Ether gains, that it's just really fueling, people see these ICOs coming out. Sometimes they probably don't do as much due diligence as they need. They wish there was other information, but they see these returns, and it's just so insane that it obviously fuels just a lot of people wanting to get in.
I'd like to add one quick nuance that sometimes gets lost in this hype around like data and venture capital, and are we going to overtake venture capital? The fact is that we're talking about new instruments. These are not equity-like instruments. These genuinely are crypto tokens, which have different characteristics than traditional equity or debt instruments that you have. And so, some of the reasons we see why projects do want to go this token route, the most common reason is because you are unable to raise VC funding because your team could be completely different geographically, or you could be working in something so specialized that there are probably like 3 VCs in the world who even understand what you're doing. But putting it out in the open market, you get a better audience. However, I think the other important aspect to remember is, like with the coming up of these protocol tokens especially, the ICO is not just a way to raise money. It's a way to gain your users. And it's very essential for certain tokens to be distributed as widely as possible. So many of these protocols actually would not work if a VC came in, gave you that money, and took like 50% of your supply. That's worth $0 exactly. And you genuinely need an ICO just for the distribution of the model as well. So I think that's a nuance that people should keep in mind when you're comparing VCs to these, like a completely new asset class that we believe is emerging here.
If I could add some context as well. So just a normal seed fund valuation is probably like $5 million. The Series A is probably like 15 or 20. This morning when I logged into CoinMarketCap, every single coin on the top 100 page had over a $10 million valuation. That's pretty crazy. A seed round is hard enough to raise. A Series A round usually requires you to have a pretty decent traction and revenue model, and yet 100 different coins out here have over that valuation right now. So just throwing out some context. Also, EtherScan, pretty great resource in the industry. You're able to see sort of the distribution of holders of these different tokens. Most of these Ether-based tokens are usually have about a few hundred to maybe a couple thousand distinct addresses or people that hold these tokens.
Ethercan is here, right? In the room. How are you? Two guys. If you want to comment, you have anything? Okay. You have good data. You mentioned something about the fact that a lot of these ICOs or token sales are getting money from recycled gains. And I'm trying to get a number in terms of what is the ratio of money that's coming from within as opposed to coming like new money, like real money, not money that was just gained by Ethereum and Bitcoin and so on. So what's your estimate, like across the panel here of, my estimate is 3/4 from within and 1/4 from the outside, shifting towards more to be coming from the outside going forward. But
I think that's pretty accurate. I mean, most of the new money coming in obviously looks as Bitcoin as the most conservative token, Ether probably next, and then, you know, Ether dApps obviously from there. 75% being from already within Ether and Bitcoin game seems pretty accurate. And I would say I'm kind of skeptical that there's a lot of really brand new money who have dollars who don't have much crypto experience, who are then trying to figure out how to funnel those dollars directly into an ICO on a website. It seems kind of like a pretty big jump to me. Most people would probably start with Bitcoin and Ether first.
It seems that the relative market cap of Bitcoin and Ethereum versus the rest of the tokens can serve as a really good proxy measure to answer exactly that question. I have to think about it a little bit, but offhand, the relative drop in market cap of Ethereum and Bitcoin compared to the entire space indicates that, in fact, it's correct, that a lot of money is coming out of the Ethereum and Bitcoin holdings.
Also, I guess there's just the fact if you've ever tried to participate in a crowdfunding or ICO, it's just not as easy as, I mean, most of these retail people who have the experience of like going onto E-Trade and just clicking buy, you know, that is similar right now. Coinbase is really easy to buy Bitcoin and Ether, but most of these other sites don't, I mean, you can't directly buy an ICO through some sort of service like that. It doesn't exist yet. Maybe you can buy some of the secondary market tokens on exchanges like Kraken or Bittrex or Poloniex after it's already out in the open, but it's pretty intimidating for people to you know, participate in an ICO. You can't even send funds from a centralized exchange like that to a lot of them. So you need to figure out how to run like Mist or use My Ether wallet or something. It's just a bigger step than doing something like buying Bitcoin.
is that going to change? And I want your number as well, Sid, 1 second. So is that trend going to change though? I mean, we have to make it easier for consumers, no?
Yeah, so I just wanted to add to that from the same survey I mentioned before. 95% of respondents said they held cryptocurrency, but actually only about 1 out of 3 ever participated in a token sale. So even people who are in the space are fairly intimidated by the complexity of doing it and maybe the risks and technological issues. So that confirms kind of what you were saying.
What do you think, Sid?
I think in the last 3 days we were at Consensus, and if you talk to the suits there, it looks like everyone who was working on Corda and private blockchains is now in the public blockchain space. So I mean, you could argue that's the dumb money entering the space now. But I think, I mean, looking at it from a data perspective, it's actually surprisingly common question. Obviously, it's something that everyone wants to know the answer to, but it's surprisingly difficult to answer accurately because the on-ramps and off-ramps are so based, again, on cryptocurrencies. If someone buys Bitcoin today, how do you know if it's to buy Bitcoin or if it's to invest in a token sale right now? Because usually just these token sales are almost impossible to buy with your fiat currency trading pairs. Mm-hmm. So I mean, I think we don't have enough data to say definitively where people are buying this and how much percentage, unfortunately.
I would be curious to see if the entry point, I mean, the entry point traditionally has been Bitcoin. And I wonder if that is shifting a bit more to Ethereum because
many of the Ethereum tokens that Brian covered in the presentation, the Ethereum-based tokens, which we're seeing grow up much more, and a few other meta token protocols as well. So we're seeing things on counterparty waves and a couple of other things that are coming up. But for Ethereum tokens, just by the way, the ERC20 tokens are coded today, which is the most famous way to raise money and do like a token sale on Ethereum. That definitely needs Ether. So unless you have some kind of integration like a Shapeshift or something, you definitely need Ether to invest in those tokens.
One thing that bothers me is the disconnect between the market, what the market does to a particular token, and the reality of the business model starting to kind of work and show signs and real metrics of success or no success. And the gap is still quite wide right now. And so that bothers me a little bit, but should we be bothered by it, or is it going to be naturally closed eventually? Or there is a crash at some point in time and then we go to reality and then we start to grow again more gradually. What do you think the scenarios might be?
It's a great question, William. We will crash. We will crash many times. And it's only in retrospect that you can generally judge what reality is. But I think there is, in fact, a really good reason to be optimistic. And that's because what these tokens signify and what these economic models signify is a promise of a completely new way to structure and collaborate, to structure collaborative efforts between distinct people in ecosystems and businesses and organizations and across borders. And I think the exuberance is there because people can feel just how important this is. I think the reality, as always, will show that it's a lot harder than you think, and it will take time to get there, and it will take many mistakes. And if you look at last year and all the hacks and the DAO crash that happened, and the contagion between the DAO crash and the Ethereum, price behavior was particularly interesting, and all of those things. We're just learning about what decentralization really means. But what we do know is that if we can succeed at decentralizing, then we can have something that is, probably, in my view, more powerful than, nuclear energy, because it's the power of people working together in a new and hugely global way.
Yes. So in closing, I want to ask you for your next year's projection, but I'm talking dog years. So, because the space is going so quickly. So in 3 months from now, that is dog years. In 3 months from now, any wild projection? It could be either the price of Ethereum or Bitcoin, or something is going to happen.
I'll
quickly.
go last on this one. I'll go last on this one.
I'll go first. I think we're going to see a continuation in the amount that token sales will raise. I think we'll see 30, 40, 50. We might see 100 by the end of the year, maybe more.
For the year?
Before the end of the year.
Oh, for sure. I think so.
Oh, okay.
I
Then I think we figured it out, William.
That's okay.
All right.
I mean, in the next 3 months, I feel like right now the price is going up so much, more and more people are getting exposed to it, more traditional faces are starting to see it. I think more money will probably come into this space. What I'm looking forward to and think will eventually happen, maybe in a little more than 3 months, is we'll start to see a shakeout. So I don't think there should be 100 tokens with a market cap of 10 million right now. So I think some of those will fall in price and get liquidated. However, I do think a lot of that money will flow back into sort of the bigger assets right now. So I don't really foresee a big fall in, like Bitcoin and Ethereum. I think when a lot of these tokens do have sell-offs, money will flow back into those big protocols. And most people I know are just pretty adamant about holding Bitcoin and Ether and really not selling back to fiat. So I think the market composition will shift, but overall it will continue to grow.
Okay.
Yeah, I think it's, over maybe slightly longer term, maybe like 1 year or so, I would say we could likely see regulated financial products come up. And so there's this whole sea of barrage of money, that's institutional money, that's never going to touch the space as it is right now, irrespective of how much this grows and what returns you see. And there could be, I think there will emerge ways for this money to start investing in the space.
If I could make one more statement, I think to your point before, this gap between live and not live projects, I think these simple agreement for future tokens and like institutional capital getting involved, we'll definitely see a shift in, these projects will start to get funded by almost like seed rounds or more traditional money at the onset, get advisory services or what have you, and probably launch their ICO or token sale closer to the actual live product in the future.
Yes.
Which I think is a good thing.
Quickly, Alex.
So I'll make a bold prediction. The bold prediction is this trend will definitely continue, but on the horizon of 3 to 5 years, I imagine that not a single cryptocurrency that we know of today will be in the top 10 by market cap.
Interesting. Thank you.